Welcome to the set of videos regarding the adjusting process. In this particular chapter, we are going to be talking about a variety of topics, but mainly we're going to talk about the matching concept, the nature of the adjusting process, and recording adjusting journal entries. Now, before we can get to the adjusting process, we need to understand the matching concept. And we can't do that until we understand a couple of other items. So the first thing that we need to understand is the accounting period concept. The accounting period concept. And basically what that says is that companies' activities can be broken down into specific time periods. So if we think about time as a continuum or as a line, basically it just goes on indefinitely and there are no breaks or stops in it. But when we're talking about accounting, we need to be able to segment our accounting transactions into certain periods of time. So we need to make an artificial break in the time periods so that we can determine what goes in, let's say, year one versus what transactions, what items would go into year two. So these time periods are typically either a month, a quarter, or a year. So assuming that we're talking about a year, we'll make it simple and say that our year ends on December 31st. So this is our artificial break in time, where we have everything from January to December on this side of the line, and then everything from January to December of the next year on that side of the line. So when we look at individual transactions, if we have something in July of year one, it's very easy to say that it goes into year one. If it's in September, it goes in September, October, November. All of those things are very easily identifiable as going into year one. Same with year two. If we have something in April or May, it's very easy to identify that they do go into year two. Even if something is in February. But what if we run into the situation where we have a transaction where we enter into an agreement on December 30th for something that's going to be delivered on January 2nd? So that becomes a little less clear. So when that occurs, we need to use our accounting understanding along with the terms and agreements made with that transaction to know which time period does it go into. Do we put it into period one or do we put it into period two? But the important thing to know is that it does need to go in one of those specific periods, and there are rules that govern which period a transaction should be recorded in. So now that we know a little bit more about the accounting period concept, the next thing we need to look at is our basis of accounting. And there are two general bases of accounting. First, we have the cash basis, and the second is the accrual basis. So under the cash basis of accounting, revenues are recognized when cash is received, and expenses are recognized when cash is paid. So it's a relatively straightforward system. Cash in is revenue, cash out is expenses. Now on the accrual basis, it is a little bit different. On the accrual basis, revenues are recognized when they are earned, and expenses are recognized when they are incurred. So these two items don't necessarily depend on the cash portions of the transactions. So when we're looking at the transactions that we've been doing up to this point in our course, we can think back to Jim's lawn care, and a sample transaction would be that we performed lawn care services to a credit customer on account. So in that case, we would debit accounts receivable, and we would credit fees earned or a revenue account. Now in this case, where is the cash? Well, there is no cash portion of the transaction at this point. We have received a promise from our customer that they're going to pay us, but we have actually performed the service, so we are going to recognize the revenue. So that means that we have actually been using the accrual basis of accounting throughout this course. And 99% of the time, we are going to be using the accrual basis of accounting within this course. It is what is used under generally accepted accounting principles, so we are going to utilize that basis of accounting when we're going through our various transactions. So now we know that cash basis of accounting and accrual basis of accounting, those are different. Now, this idea of earned and incurred sounds easy enough, but it can get a little complicated. So I'm going to go through an example with you of what we mean by that, and we're going to introduce the matching concept to you at this time as well. So let's look first at our example. So we've got a company, and they signed and paid for a 1-year security contract on July 1st for $24,000. So if we look at this from a cash basis, first off, we will get one sort of understanding about what happens. So under the cash basis, a 1-year security contract on July 1st for $24,000, and we are going to assume that we have a December 31st year end, so we're going to have that artificial break in time here for the accounting period. And so that means that this contract goes over 2 accounting periods. We've got part of the contract in year 1, and then part of the contract in year 2. But under the cash basis of accounting, we are going to show one transaction on July 1st, where we are going to debit our security expense. So I'm going to abbreviate that, SEC for security expense. And we're going to credit cash for the $24,000 of the cash that was paid out. So that is the accrual, or that is the cash basis of accounting. Remember, expenses are recorded as cash is paid. So in the cash basis of accounting, we have cash being paid on one day, so we are going to actually recognize the entirety of the contract on one day. And that's going to translate to the entirety of the contract is going to be recorded within year 1 of our financial statements, and there's going to be nothing that happens in year 2. And from a cash perspective, that is true, and that is what happened. But if we look at it from a business perspective, we have to step back and think to ourselves, well, yeah, we paid the cash, but did we only benefit from that contract on July 1st? Or did we only benefit from that contract during year 1? And the answer to that is no. So our financial statements don't really reflect an accurate representation of what's going on within the company and how we're utilizing this cost that we've incurred. So the cash basis of accounting is flawed from that perspective. So if we look at it from an accrual basis of accounting, then we also have the same transaction where we enter into our security agreement on July 1st. And we are, of course, going to credit cash because we did, in fact, pay the cash out. So we have to record this transaction. But under the accrual basis of accounting, we're going to look at it from a broader perspective and consider how it is that this contract is benefiting us. Is it benefiting us just for one day or just for a short period of time, or is it actually benefiting us for the entire 12-month period of time? And looking at it from that perspective, we can say that it is benefiting us for the entire 12-month period of time or the entire year. So we can't show it as a cost, as an expense on July 1st because we haven't utilized the entirety of the contract on July 1st. Instead, we're going to initially record it as an asset as prepaid security. So prepaid security, we're going to debit as an asset for $24,000. And we're going to credit cash for $24,000. Now, of course, that security contract, we're going to use it up over the course of the year, so it's not going to stay an asset forever. In fact, we are going to show on a monthly basis the using up or the utilization of that asset, and we're going to show that we're using it up, and we're going to then show an expense related to it. So as we move along, each month, we're going to utilize part of the contract. So if our contract is $24,000 and we utilize it over a 12-month period of time, we're actually utilizing $2,000 per month. So we have $2,000 that we used up in in July, and $2,000 that we used up in August and September and October, November, December, January, February, March, April, May, and June. So we're spreading out the expense over the entirety of the life of the asset. But what we're going to do each month, so at the end of the month, we are going to show that utilization. We're going to show the cost of doing business as well as the reduction in the asset. So in this case, we have a debit to prepaid security as an asset. Now to reduce that, we need to do the opposite. So we're going to credit prepaid security for the $2,000 that we used up in July. And the debit is going to be to the cost of doing business. It's going to be to the expense account or security expense account for the $2,000. So in this case, we are matching the expense into the period in which the related revenue was earned. So we'll be talking about that numerous times during the various chapters in this course, but basically the matching concept says that we match expenses into the same period the related revenue is earned. So by that we mean that, no, the security didn't generate the revenue, but the security had an indirect benefit to help the company earn the revenue. So by having security, the employees feel safe. By having security, the business location is safe. The assets are safe. There are assets in place that haven't been stolen. So indirectly, this security has helped the business in its revenue generating process. Of course, it isn't that direct person that's doing the work or the product that's being sold, but it is indirectly helping the business to generate the revenue by helping the business in by means of keeping it secure. So with that information, we can match the expense into the same period the related revenue was earned. And we will do that journal entry a total of 12 times. So we will have the same journal entry on August 31st. So we will have a debit to security expense and a credit to prepaid security for $2,000. So that over time, we're going to what's called amortize the contract. We're going to amortize this asset to show the utilization until the asset value is 0, and we start all over again with paying for a new contract. So if we look at the asset from a T account perspective, so we have prepaid security as a T account. Then on July 1st, we debit the $24,000 into the asset because we've paid for it in advance. And then at the end of July, we show that we've used some of it up. So our balance at the end of July within the asset account is $22,000. Then we do it again at the end of August. And so on and so forth until at the end of June, our asset balance is 0. Our total expenses have been recognized, and we can start over with a new contract. So essentially, we have an interesting thing going on. So if we look back at our cash basis of accounting, remember this entire $24,000 was recognized in year 1, and absolutely nothing was recognized in year 2. Then under the accrual basis, I'm going to have to smash it in here a little bit. Under the accrual basis, if we add up those 6 months together in year 1, we're going to have $12,000 of the security contract recognized in year 1. And then we're going to have $12,000 of the cost of doing business associated with the security show up in year 2. So that gives a much more accurate representation of what's going on within the business, because we are actually using the security every single day of the entire year. We're not just benefiting from the security on one day or in the first 6 months. We're actually benefiting from it over the entire year. And by separating it out on a monthly basis, we're actually doing that. And summarizing it, we're showing, in this case, half of it in year 1 and half of it in year 2. But interestingly, and I couldn't get it all on this one page, but interestingly, if we do a little summary here, remember the cash basis, we had $24,000 that was in year 1, and we had 0 that was in year 2. Under the accrual basis, we had $12,000 in year 1 and $12,000 in year 2. So what's interesting is that the total amount of the expense that's recognized under both methods is exactly the same. It is $24,000 under both methods. The important thing is the timing of when those expenses are incurred. So under the cash basis, everything shows up as one lump on July 1st, whereas under the accrual basis, it is spread out over the actual time period under which we're benefiting from the security contract. So that is an introduction to the matching concept. So one more time, we are going to match expenses into the same period that the related revenues are earned. And we're going to do that over and over again throughout the course.